Hi, welcome to the channel. My name is Joseph Gutierrez, owner of MyLifeInsuranceBroker.net, and this is Covering and Compounding. Today, we're going to be talking about all the different types of term life insurance policies that you didn't know about. Generally speaking, on this channel, we talk about using permanent life insurance as an asset class that I call the foundational asset, an asset that grows compound interest uninterrupted, is tax-free, an asset that allows us to get other assets and to double up as a form of income in retirement. That said, for some individuals, a term life insurance policy is all that they need at that particular time. And here we have the philosophy that some insurance is better than no insurance. When the time comes that that individual wants to upgrade to the foundational asset, we can have that conversation. But for today, we're going to be talking about term life insurance. So let's get started. So why would we be even interested in term life insurance in the first place? Why not just get a permanent life insurance policy? Well, one of the most defining attributes about term insurance is that it's relatively inexpensive, especially for the type of client that it serves. For an individual in the early years of family formation, money's typically tight, expenses are high, liabilities are even higher, right? Think about it. We have a mortgage, we have car notes, we have all kinds of different expenses, maybe student loans, and we have our whole earnings potential along the way that we need to cover for in the event of some kind of catastrophe where an income earner were to pass away. This is why many people turn to term life insurance to satisfy their insurance needs. That said, we're going to get into what is term insurance and how is it actually constructed. So what is term insurance? Term insurance is a temporary form of life insurance that provides the insured with a certain amount of death benefit for a fixed specific length of time. For example, an insured may be interested in a term life insurance policy of $400,000 of death benefit for a 30-year period. Keep in mind, this is one of the most purest forms of life insurance there is. You get a fixed amount of death benefit for a specific fixed amount of time. And that's it, essentially. We can add riders to it for children plans, for accidental death coverage, and most importantly, we can add riders for accelerated death benefits for critical, chronic, or terminal illness. So essentially, if the insured undergoes some kind of catastrophic health event, the doctor's note, they can have their death benefit sent to them while they're alive to help pay for the medical and living expenses associated with that illness. To start off our discussion on the different options within the term insurance realm, we're going to be talking about probably the most common form of term insurance, which is called level term. Okay, so for this type of term insurance, we're going to have a low relative premium payment for a relatively large death benefit amount. Term lengths range from 10 years to 30 years in 5-year increments. Most insured individuals like this form of insurance because it covers a mortgage and other large liabilities in the early years of family formation and wealth building. We oftentimes hear the acronym DIME, which stands for Debt, Income, Mortgage, and Education. These are some of the larger expenses that a family were to incur during their more formative years. In the example of a level term policy, say for our typical example of $400,000 death benefit for 30 years, it doesn't matter if an individual were to pass in year 1 or pass in year 29, the individual's beneficiaries would have access to the full death benefit amount, or in this case, $400,000. So next, we're going to be talking about decreasing term. In our next most common form of term insurance, we now have decreasing term. So decreasing term is great because it tends to be a little bit cheaper than traditional level term. Decreasing term means that the death benefit will decrease over time during that fixed time period. So for instance, our $400,000 death benefit will reduce as the years go by to essentially zero at the end of this 30-year term. Why do people like this type of term insurance? Well, because it tends to follow a traditional amortization schedule that may be attached to, say, their home mortgage. Just like level term, it comes in 5-year increments from 10 years to 30 years. The death benefit decreases slowly over time, which allows the premium payment to be a little bit lower than traditional level term. But keep in mind that the payout towards the end of the term length will be substantially less than in the beginning. The next type of term insurance policy that we're going to be talking about is called income protection term. So why would we be interested in income protection term? Well, because this provides a constant stream of income replacement to cover family expenses, most commonly used to cover a mortgage and any other bills along the way in the event that the insured were to pass. What's nice about this particular type of term insurance is that it prevents the lottery winner effect, where the individual, the beneficiary, receiving a large lump sum may overspend that lump sum to the point where later they're in a situation where they don't have enough to cover the mortgage or other expenses. What's nice about this is that the death benefit can be broken up with an initial lump sum, a final lump sum, and a payment period in between. That payment period obviously would be able to cover most family expenses along the way, depending on the amount of total death benefit that was arranged for. So for instance, an initial lump sum of $50,000 for the possible burial expenses, and then an income replacement income of, say, $4,000 a month for a period of 15 years. Once the 15-year mark is over, there may be an additional lump sum payment at the end of the 15 years, and then the contract has been satisfied. This gives the surviving beneficiaries and family unit peace of mind knowing that a monthly payment check will be there for a time. The next type of term insurance policy that we're going to be talking about is called return of premium term. So when we talk about term policies, the thing to keep in mind is that most term policies expire with no death benefit claims. Perhaps only about 2, maybe 5% of their death benefit will be sent to the beneficiaries. Because of this, term can appear as a sunk cost with little benefit outside of the low probability of an early death event. Remember, there is no cash value accumulation with traditional term. Because of this, insurance companies came up with a strategy to provide all or a portion of the premium payments that were made during the term length to be returned back to the insured at the end of the term. These options come in 50%, 75%, and 100% return of premium. Because it's a return of premium, the lump sum that is given back to the insured is tax-free. This can be viewed as a long-term savings vehicle for the client. Keep in mind, return of premium term policies are a little bit more expensive than traditional term, but because all or a portion of the money is returned, this adds an element of a win-win strategy between the insured and the insurance company. This strategy allows for long-term family planning, where a lump sum is going to be returned to the client in the event that no death benefit claim is made. Next in our series is what's called the convertible term policy. Convertible because it turns into a whole life policy. Oftentimes when individuals purchase term insurance for a period of, say, 20 to 30 years, they forego any type of permanent life insurance, strictly for the low premium and high death benefit coverage. This is okay for a period of time. However, once their term policy expires, the insured tends to realize they still want to have some basic form of permanent coverage for a low price. If the insured waits until their 50s or 70s to buy permanent life insurance, they will be paying much more for that coverage, even a reduced amount, essentially missing the boat on low-cost coverage. Convertible term allows for this large death benefit when it is most needed, and then when the term period ends, the policy will automatically transition into a whole life policy at a lower death benefit for the same premium payment as the term period. Options generally include between 25% or 10% of the initial death benefit. So in our example of a $400,000 term policy, at the end of those 30 years, a whole life policy will take over in the amount of $100,000 death benefit for the remainder of the insurer's life. This is great because the premium payment remains the same. The last type of term coverage that we're going to talk about in our series today is called the term rider. And it's called the term rider because it's actually part of an overall whole life policy. This is often used for families that want to minimize their insurance costs in the early years with the term rider, but still want to have a whole life policy in force that provides them with additional cash value accumulation and overall general permanent coverage. For example, an individual might have $100,000 whole life policy with a $300,000 30-year term rider attached. The insured will now have a total of $400,000 for 30 years. When the term policy expires, the insured will still have their $100,000 whole life policy locked in at the low rate when they put the policy together 30 years prior. Depending on the needs of the insured, we may also be able to put together a policy with a mutual insurance company that pays a dividend. This dividend may increase cash value and death benefit over the life of the policy. For example, this $100,000 whole life coverage may translate into a $200,000 plus death benefit by the age of retirement, with possibly $100,000+ cash value available for loans and withdrawal. Actual numbers for cash value and death benefits amount are dependent on age and health factors and policy formation. Ask us for a custom policy illustration and how one can be used to benefit your insurance needs. In conclusion, term policies have many different options, from the more basic to more versatile and beneficial. Ultimately, the right term policy is one that matches your budget as well as your family's goals. Keep in mind, most agents don't have or are not aware of the nuances inside of term life insurance policies. If If you see a particular type of term policy you'd like to explore, click the link in the bio to set up a free, no obligation online consultation. Thank you for watching our video. Click like and subscribe for future content, and I look forward to seeing you on our journey towards financial independence. Until next time.